Hello and welcome to my short video recording series. The topic we'll be covering today is understanding fixed income risk and return. So today we'll be covering the first section of this particular reading. And before going through the video, just make sure that you have covered the other readings and you understand the basic concepts of fixed income. All right, so for this reading, we are going to assume that there are two types of investors. We're going to look at two types of investors. Number one is a long-term investor. And for now, we would define a long-term investor as a buy and hold investor. So basically, buy and hold investor is that investor who will buy the bonds today and hold it until the maturity of the bond. And the second type of investor that we assume is basically the short-term investor. So if we take an example of a 10-year bond, let's suppose a buy and hold investor would be the one who buys a 10-year bond today and holds it until the maturity, while the short-term investor would actually sell it prior to maturity, such as maybe the short-term investor would sell the bond after 4 years. Later on, we are going to more accurately look at how we define long-term investor, but that should be covered towards the end of the reading. For now, it's okay to know that the long-term investor is actually the buy and hold investor. All right, when we speak about return or your source of return when you buy a bond, your return has 3 components when you buy a bond. The first component is your coupon, which is the interest that you actually earn on the par value. And the second component on your return is capital gain, which is also called change in price. That is the change in price of the bond that you actually buy. So these two are your components of your return. But when you get the coupon, let's say if it's a 10-year bond that is offering you coupon, of course, you're going to reinvest those coupons also. So the return that you get from the reinvestment of interest or coupon is called reinvestment return, which could also be called interest on interest or reinvestment return. So these are the 3 different types of returns you actually earn when you buy a bond. All right, so let's look at interest rate risk. When we speak of interest rate risk, broadly speaking, you can divide it into 2 types. You have something called price risk. And price risk is something we have seen earlier in the valuation reading, which is as interest rate goes up, the price of the bond actually goes down. That is, the sensitivity of price to change in interest rate is actually called price risk. And this was called as inverse effect, which is the inverse relationship between price and interest rate. On the other side, if you notice, when interest rate goes down, then that causes your reinvestment risk. So your reinvestment risk is as interest rate goes down, your reinvestment return actually goes down. So your reinvestment return would be lower. So on one side of the movement of interest rate, there is price risk. And on the other side of the movement of interest rate, there is reinvestment risk. Now, we spoke about 2 types of investors for this reading. We said long-term investor, which is the buy and hold, and short-term investor. So if I ask you, for a long-term investor, what type of risk would matter more? Would it be the price risk or the reinvestment risk? Likewise, for the short-term investor, what type of risk would actually matter more or would be more dominant for the short-term investor? While this is something we're going to answer through the number in the coming slides, but before we prove that through the numbers, if you think about it, you can still get the answer, because if you are a short-term investor, you would be concerned about selling the bond in the market at the market price. And you would be concerned whether would you make a capital gain or a capital loss, what will be your change in price. Hence, to the short-term investor, we could say that price risk would matter more, right? So for a short-term investor, price risk is more dominant. For short-term investor. In other words, the short-term investor would be concerned about the impact of interest rate on the price movement. Will that cause a capital gain or will that cause a capital loss? And that capital gain or loss will affect the return of the short-term investor. When we speak about the reinvestment risk, for the long-term investor, because the long-term investor intends to buy the bond and hold it until maturity, therefore the investor is not concerned about the movement of the market price or fluctuation in the market price. Rather, the investor is concerned about reinvesting the coupon until the end of maturity, and hence the impact of interest rate movement on the reinvestment return would be more of a concern to the long-term investor. Hence, long-term investor is concerned about reinvestment risk. Reinvestment risk. And now in the coming slide, through an example that I would actually be using for illustration, we are going to prove what we have just discussed right now, that it is a price risk that is more dominant for the short-term investor, and the short-term investor is concerned with the price risk, while the long-term investor is actually concerned with the reinvestment risk. All right, for that, let's look at a 10-year bond. So we'll take this as an example. Let's say we have a 10-year bond, and the price of this bond, let's say it's trading today for 85.50. Let's say the coupon is 8%. And let's also say that the par value of this bond is $100. With all this information, we can calculate something called yield to maturity, which is the return that the investor expects on an annual basis, or that's the IRR on the cash flows of the bond. And I hope you already know how to use your calculator to calculate the yield to maturity. So using the time value of money functions, we'll try and come up with the yield. So we would assume, and in that case, if you're using your taxes BA2 plus calculator, N would be 10, that's your number of periods. Your coupon payment, which is in dollars, would be 8% of the $100 would actually be the $8, which is 8% of the par value. That's your coupon payment. Your par value, which is your future value, would actually be your par value, which is in this case is $100. And you're buying the bond today for 85.5. So the present value would be minus 85.5 because you're buying the bond for this much. And you compute the yield, that would be around 10.4%, which is also called yield to maturity. Now, there are several assumptions behind the number that we have calculated here, which is 10.4 yield to maturity. And we need to look into those assumptions, which are extremely important assumptions. So for the investor to be able to earn 10.4%, which is what the investor is expecting, there are several assumptions here. Number one, the investor would hold the bond until maturity. So the bond will be held until maturity. That's number one. Of course, the second obvious assumption is that there will be no default, and the investor will get all the coupon payments, which are cash flows, $8, and then in the end, $100 as well on time. So the second assumption is that there is no default and all the cash flows would be received on time. And the third and extremely important assumption is what happens to these cash flows that you see here? 0, 1, 2, 3, all the way until 10. And the cash flows are 8, which are the coupon payments. And the last one is 108, which is par plus the coupon. So what happens to these coupon payments that the investor receives? The assumption is that the investor would actually reinvest all these coupon payments until the end of the maturity, until the end of the investment horizon. And the question that arises is, at what rate of return would the investor reinvest these? And the idea is the investor would be reinvesting at the same rate as the original yield that has been calculated in order to earn the same return as the original yield. So the third key assumption behind yield to maturity is that the investor reinvests cash flows at the same rate as the original yield. And what I mean by the original yield is the one that we calculated, or is the one that investor expects on the first day. So based on the original yield, in this case 10.4%. In other words, we are saying that we should be able to reinvest at 10.4%. The question then arises is, will the market rate be the same as 10.4 or not? Because if the market rate is different after 1 year or 2 years or 3 years, then we would be reinvesting at different cash flow, at different rates. And hence our actual return could look different than the original yield, which is what we are actually expecting. And that's exactly what we are going to see on the next slide. You're going to see if the market rate during these 10 years is different than 10.4, let's say if it's higher or lower, what will be the impact on the actual return for the long-term investor. So far what we have calculated is the original yield, which is what you are expecting. You may also call this as an expected yield, versus we're going to compare this against the actual return that the investor would earn. And that actual return could also be called as horizon yield. But I would call it actual return because that would be a more simpler way to actually look at. Now, how do we calculate the actual return? Well, we have already calculated the original yield that the investor expects based on what we have on the first day. So how do we calculate the actual return for the long-term investor? Well, first thing we need to know when we speak about actual return, again, you may also call it as horizon yield. It's a term being used in the textbook. So the return can be calculated as you may know from your quantitative methods, as ending value minus beginning value divided by beginning. This would give you the percentage change, or alternatively, you can calculate it as ending divided by beginning minus 1. One thing you need to pay attention to, that since you're buying the bond today for 85.5 and you're holding it to 10 years, the ending value you would get after 10 years. So this is the ending value after 10 years. And if we use this formula to calculate the actual return, we would get a 10-year return, while the actual return should be annualized. Just as the original yield is annualized, actual return should also be annualized. So in a quick way, we can annualize this by decompounding to the power of 1 over 10 minus 1. And this should give us our actual return. Now, what is the ending value? That's what you might ask. What is the ending value then? As a long-term investor, if you're holding until 10th year, your ending value after 10 years would be what you actually get after 10 years. And this would be the par value, because you're getting par by the end of 10th year. And what do you do with your cash flows, which are coupons? Of course, you reinvest them. And that's what we said. You're going to reinvest them until the end of 10th year, until your end of your investment horizon. So you are getting back two things. You're getting back par value plus future value of reinvested coupons, because you are reinvesting your coupons. In short, let's call this FVRIC, future value of reinvested coupons. All right, while par should be obvious, par is $100 as we know. How do we get future value of reinvested coupons? Well, I'm just going to show it to you shortly, and then we will go ahead with the calculations under different scenarios. So if you have to calculate future value of reinvested coupon, the first thing is to be able to get your coupons on the timeline properly. So here is how it would be. So 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And what are our cash flows? This is 8, 8, 8. Keep in mind, we want to find future value of coupons. We don't want to find future value of all cash flows. We want to find future value of coupons. So we're not going to put the par value here because we just want future value of coupons only. So on the timeline, you'd only have to put the coupons alone. A common mistake is to put the price at time 0. We will not be putting the price. There is no coupon here. We only want to find the future value of reinvested coupons. So there is no coupon at time 0. So make sure you know that the present value in this case would actually be 0 because there is no coupon at time 0. So on the timeline, we only put our coupons so that we can find the future value of coupons. And here is what you would have to actually plug in into your calculator. You're going to say n in this case is 10, of course, keeping your calculator in the ending mode, because as you can see, the NBT in this case begins from the end of period 1. So we would assume n is 10. The coupon payment in this case is $1, as you see. And the present value at time 0, there is no coupon or no cash flow at time 0, hence that would be 0. And at what rate do you reinvest? What will be the yield? This will be the market rate, whatever is the market rate, because we would assume by the end of year 1, whatever is the market rate, you would reinvest at that particular market rate. And then you just simply compute your future value of reinvested coupons. That should give you the answer. And once you have the answer here, we just simply plug it up here and we can find the actual return. So what I've shown to you right now is how to get the actual return, or which may also be called as horizon yield. And then not to forget, we are going to compare the horizon yield with the original yield. The whole point we're trying to make here is, what if the market rate is different than 10.4 and we reinvest our coupons at different rate? What will happen to our actual return? Will it be the same as original yield, which we already calculated, or will it be different? So let's answer that, and let's use 3 scenarios here. Our first scenario is going to be, so we look at 3 scenarios. Our first scenario is where the market rate during these 10 years is 10.4%. Our second scenario is where the market rate during these 10 years increases to 11.4%. And we're making simplified assumption that it remains at 11.4 over the next 10 years. And then the last scenario, that market rate over the next 10 years would actually drop down to 9.4%. So these 3 scenarios, and in all these 3 scenarios, we're going to calculate our actual return, which is horizon yield, and compare it with original yield, and see how the fluctuation in the market return, which is the interest rate, affects our horizon yield. All right, so because the market rate is 10.4, as a long-term investor, and keep in mind we're talking about long-term investor only right now, you would be able to reinvest your coupons or cash flows at the same rate as the original yield. So let me write the original yield that we calculated before here as a reference. It was 10.4%. So without even running through the numbers, you can see, because the investor would be able to reinvest the cash flows at the same rate as the original yield, hence the horizon yield or the actual return should equal the original yield. And let's prove that. We've already seen the formula. These are the steps you would actually be following in order to calculate your horizon yield or actual return. So the formula for actual return, let me call that in short AR, was ending value over beginning to the power of 1/10 as a long-term investor, and then we subtract the 1 from it to get our actual return. And how do we calculate the ending value? We said ending value is going to be par plus future value of reinvested coupons. The par, as we know, is $100, while future value of reinvested coupons, I repeat again, I would just go back to this. Make sure you don't forget this. You always need to draw the timeline. Make sure you don't put the price here. There is no coupon here because we only want to find the future value of coupons, and we are going to use the same timeline. So future value of reinvested coupons can be calculated as we would say n is in this case 10. The coupon payment, as we saw in the timeline, is 8. The yield, which is the market rate at which you are reinvesting, is 10.4%. And the present value again is 0 because there is no coupon at time 0, and we'll just simply compute the future value. And the future value that we get is 129.97. All right, so we add that here, 129.97, and that should give us 229.97. This is what you're getting back. If you calculate the actual return, you should get, how much did we buy the bond for? The bond was priced at 85.5, as you can see here. So we would just say 85.5 to the power of 1/10 minus 1. And the actual return, which is horizon yield, is the same as the original yield. Now the question is, why is it the same? If you go back to the three assumptions we discussed, number one, you're holding the bond until maturity. Number two, we assumed there is no default, so the investor was getting all the coupons on time, and the investor finally reinvested all the coupons at the same market rate as the original yield. Hence, the horizon yield or the actual return is the same as the market return. Going back to what we had covered already, we said that the long-term investor returns, which means the long-term investor horizon yield or actual return, will be mainly affected by the reinvestment return. As you can see, interest rates are going up to 11.4. That's the assumption we're making in scenario 2. And you can imagine if interest rate will go up to 11.4, the future value of reinvested coupon would actually go up because you are reinvesting at higher return. Hence, the ending value would go up, and hence the horizon yield would actually be higher than the original yield that the investor was actually expecting. So you should expect that the actual return in scenario 2 would actually be higher than what we have already seen in scenario 1. Likewise, in the last scenario where market rate is lower and the coupons would be reinvested at lower return, therefore the actual return should be lower. So let us just follow the same steps to actually quickly try and get these numbers. So I wouldn't be writing the formula again. The actual return would be ending over beginning. Let's try and get the ending value by the end of 10th year. It will be par value, which is $100 plus future value of reinvested coupons. Let's get our FVRIC. Everything is going to be the same here. N is going to be the 10, payment is 8. Yield would be your market return, or which in this case is higher, 11.4%. Present value, again, is 0. When you compute the future value of your coupons, it gives you 136.38. Notice, just compare the number we got before with this number that we actually got now. Your future value of coupons is higher because you're reinvesting at higher rate of return. And that's your FVRIC. If we add the FVRIC, as you see here, 136.38, you should get ending value is 236.38. Notice your ending value is higher than the first scenario because of higher reinvestment gain. And if we go back to the actual return formula and plug in the numbers, which is ending value divided by beginning value, you're buying the bond for 85.5 to the power of 1/10 minus 1. And your actual return is higher, which is 10.7%. As you can see, this is more than the original yield. So your actual return, if I use a different color here, the actual return of the investor is more than the original yield. And what's the reason for this for the long-term investor? What's the reason that the long-term investor actual return is more than original yield? Because the market rate was higher. Market rate went up to 11.4, resulting in high reinvestment return. And because of that reinvestment return, the investor ended up making higher return, which is the actual return would be more than original yield. And this just simply proves the point that the long-term investor returns are mainly affected by the reinvestment gains or losses, or high reinvestment return or low investment return. So if we look at the numbers for the last scenario, you can answer this without even proceeding further. You know that because of the reinvestment rate or the market rate is now lower, hence you would expect that the actual return in this scenario would be the lowest amongst all the three scenarios that we are actually looking at. So I would start from the right, from the bottom, future value of reinvested coupon with everything else being the same. The yield, which is your market rate, would now be 9.4%. Present value would be 0. Compute future value, and the answer you get is 123.8 as expected. Notice this is lowest. The future value of coupons is lowest in this scenario because you're investing at lower rate. Hence, the ending value would be par, which is 100, plus future value of reinvested coupon, which is 223.8. This is the lowest ending value in all the three scenarios. Hence, the horizon yield or the actual return would be the lowest. And the answer is 10.1%. Again, that's lower than the original yield of 10.4%. So what's the key takeaway from all these three examples? What we basically understand is that the long-term investor returns are predominantly affected by reinvestment gains on losses. If the interest rate goes up, there is a higher reinvestment gain, as you see, and hence the actual return is higher than the original yield. When interest rate goes down, there is a lower reinvestment return, and hence the actual return would be lower than the original yield. And finally, when the interest rate stays the same as the original yield, the investor ends up making the same return, the actual return, as the original expected yield. So all we have done is we've just proved a point that we already wrote here, that long-term investor would be concerned about reinvestment risk. Mainly the long-term investor would be concerned about interest rate going down, because that would cause the reinvestment return to be lower and hence actual return to be lower. All right, so let us now look at the case of the short-term investor. So far we have discussed the long-run investor, and we already mentioned that for the long-run investor it is the reinvestment risk that matters. But we said when it comes to the short-term investor who will sell the bond prior to maturity, not hold it until maturity, it is the price risk that will be more dominant than the reinvestment risk. So we are going to prove this through numbers as we did before. For the long-run investor, we'll look at the same scenario. Let's suppose the investor wants to buy a 10-year bond priced at 85.5 with 8% coupon, and the original yield to maturity is the same as 10.4. That means the investor is expecting to earn 10.4. But let's also say that we are assuming that the investor will sell the bond after 4 years. So if the investor will sell the bond after 4 years, the question is, will the actual return of this short-term investor be the same as original yield? If we go back to assumptions behind the original yield, the first assumption was it will be held until maturity. Now, what we are going to answer is, what if you do not hold until maturity and sell it after 4 years? Will you still end up making the same return as the original yield? Yes, you could, and that's what we will see through the numbers. But how about the other two assumptions? These two assumptions should not be violated, and that's what we are going to prove when we look at different scenarios again for the short-term investor. You need to keep in mind it's the price risk that matters to the short-term investor. In other words, when interest rates will go up, the market prices would go down. Likewise, when interest rates would go down, market prices would go up. So in this case, the investor will have a capital loss, which means price loss. While in this scenario, the short-term investor will make a capital gain, and capital gains and losses will mainly influence the short-term investor actual return, which is the horizon yield, then the reinvestment gains and losses. So keep in mind that the original yield for the short-term investor is also 10.4%. Just like we looked at these three scenarios for the long-term investor, if the market rate during those 10 years is 10.4 or 11.4 or 9.4, we look at the same scenarios that during the 4 years, what if market rate is 10.4 or 11.4 or 9.4? But before that, I would like you to understand how we would actually calculate the actual return or the horizon yield for the short-term investor, just as we discussed for the long-run investor. So for the short-term investor who will sell the bond after 4 years, the same bond, the actual return or the horizon yield will be calculated as ending value over beginning, because it's after 4 years. You're going to sell it to the power of 1/4 because you want to annualize it minus 1. Now the key question that arises is, what will the ending value be after 4 years? Are you going to get par value if you have bought a 10-year bond with 10-year maturity? Of course not. You're going to sell it in the market after 4 years. So let's say the cash flow that you would get will be the selling price after 4 years, which will be the market price after 4 years, plus what else do you get? What do you do with the coupon that you get for these 4 years? Of course, you reinvest this coupon. So we will have future value of reinvested coupons for 4 years. Now, let us see how we would individually calculate one by one the SP4, which is the market price after 4 years, and the future value of reinvested coupon after 4 years. So when we speak about SP4, And now we need to refer back to the valuation reading for bonds that we've earlier discussed. The value of the bond, as we know, is present value of future remaining cash flows, right? That's what we know. It's present value of future remaining, or simply future cash flows. If I draw the timeline here, we are at the end of year 4. And let's look at cash flows 6, 7, 8, 9, and 10. And the cash flows are, future cash flows are 8, which are coupons. And of course, you have 8 plus 100, which is par value. These are the future cash flows. So if you want to find the market price here, if you want to find the price here, you need to get the present value of the cash flows of this bond. So how would we get the present value? All we would say is, and in this case, the remaining time period, N is 6, coupon payment is $8, future value, which is par value, is $100. And since you want to find the market rate, the discount rate we use will be the market rate. We would just simply plug this and we would get the present value at time 4. So we want to find the present value at time 4, or the value of the bond at time 4. And this would actually be your SP4, or selling price at time 4. All right, how do we get the future value of reinvested coupon? Now, a key tip here is to make sure that you don't mix up SP4 with FOERIC. So you need to make sure that you don't mix up the two timelines, all right? So since we want to find the future value of reinvested coupon, that means you're reinvesting your coupon. So on the timeline, you should only put up your coupons only. So what are the coupons for 4 years that you would be reinvesting? 0, 1, 2, 3, 4. So what are the coupons? It's $8, 8, 8, 8, and you don't have any coupon here. Again, make sure you don't put the price here because there is no coupon here. Keeping your calculator with the ending mode, and all you need to say is N is 4, payment, coupon payment is 8. You don't have anything else at time 0, so PV0 is 0. At what rate are you reinvesting? At whatever is the market rate given to you, you will compute the future value of reinvested coupon. Once you have these two, you plug in these here, you get your ending value. And once you have your ending value, you can find the actual return, which is the horizon yield. And that could be compared with the original yield, which we calculated already, which is 10.4. So let us now look at the 3 scenarios for the short-term investor and prove that it's the price risk that will be more dominant part of the actual return or the horizon yield of the short-term investor. So we have already calculated the original yield. We don't need to look at it before. Again, it's 10.4%. First scenario, what if market rate is 10.4%? The second scenario, what if market rate is 11.4%? And the third scenario, what if market rate is 9.4%? Now here's what we can understand before even proceeding further with the calculations. When interest rate goes up, that will cause a capital loss. Price will come down. And when price will come down because of the capital loss, the short-term investor return, actual return will actually be lower than the original yield because of the capital loss. And vice versa, in this case, you'll have a price gain. Hence, the actual return or the horizon yield will be more than the original yield. So this is what we are expecting. Let's just prove this through the numbers, making sure that you understand how we actually got the ending value. All right. So in the first scenario, and once we do this calculation, I'll show you how to calculate the capital gain or loss because you're expected to know that as well. But meanwhile, let's look at these 3 scenarios first. All right. So for the first scenario, market rate is 10.4. So here's how we'll get the actual return, which is ending value over beginning to the power of 1/4 minus 1. We know that ending value is SP4 plus FVRIC, future value of reinvested coupon. I've already shown the timeline to you, so I'm not going to draw that again. All you would do is we'd plug in the same numbers. SP4 can be calculated as present value future remaining cash flows. And as you can see, the remaining cash flows are these, as I showed to you before. So all I'm going to say is, and in this case is 6, payment is $8, future value is your coupon, and your yield or interest rate is your market rate, and which is 10.4. We can compute the present value, which is simply 89.66. Likewise, we can get FVRIC. With all that is given to us, we could say N is 4 since we are reinvesting for 4 periods. Make sure not to mix these two timelines up. Payment is 8. And you're reinvesting at the market rate, which is simply 10.4%. And present value is 0. Compute the future value. And when you compute the future value, you get 37.347. which is the future value of coupons. Let's add these two up. 89.66 plus 37.34, and that gives us 127.01. Let's get the actual return by plugging in the numbers. You're buying the bond for 85.5, as you may recall, to the power of 1/4 minus 1. And here's what you see. Notice the horizon yield or the actual return is the same as original yield, even though the investor sold the bond after 4 years. The reason being that the actual return is the same as original yield is because the interest rate during these 4 years did not change. Hence, there was no capital gain or price gain or capital loss. What's going to happen in this case then when interest rates are going up? On the first day, your yield was 10.4, but interest rate goes up to 11.4 during the 4 years. Of course, this will cause capital loss. Price will actually come down. The selling price would be lower than in the first scenario. So all I'm going to do is now redo the same calculation, with the only exception that in these two scenarios, the market rate or the yield would be different. So let us see here. Let's get started with SP4, which is present value future cash flows. You'll say N is 6, payment is 8, future value is 100, yield, which is the market rate, is 11.4, and compute PV4. Notice the price would be 85.78. I want you to pay attention here. Earlier, the selling price by the end of 4th year was 89.66, but because interest rate went up to 11.4, the price dropped significantly by approximately more than $3 to 85.78. Hence, we'll have a capital loss. As for future value of reinvested coupons, since you're reinvesting at higher rate, therefore the future value should be higher. That's what you would be expecting. N is 4, payment is 8. The interest rate is 11.4 since you're reinvesting at higher rate. When we compute the future value, it is 37.89. Notice one thing. The future value of reinvested coupon was 37.34. Now it's 37.89. So it has increased, but it only increased marginally because you're only reinvesting coupons for a very shorter period of time. So the higher reinvestment gain, which is 37.34 versus 37.89, is fully offset by, as you can see, the price loss here. The selling price is far more lower. Therefore, what will be more dominant part of the short-term investment return would be the price gains or price losses. That is what we see right here. And let's now get the ending value. The ending value, if you add the two numbers, which is 85.78 plus 37.89, all you get is 123.68. Lower ending value as expected. Your actual return is 85.5, which is the purchase price. And so the actual return is 9.67. The key point is, if you compare this with original yield of 10.4, it's lower. Why is it lower for the short-term investor? Because market rate has gone up, causing price loss, causing the price to go down, causing a capital loss, as a result of which the horizon yield or the actual return is lower than the original yield. And we can look at the last scenario to continue and illustrate the same concept here. All we're going to say is the ending value, and I'm not going to rewrite everything. I would say everything is same, except that now the market rate is lower, 9.4%. When interest rates go down, of course the prices would go up. So when you compute the present value, you should get 93.79 as expected. Notice the price is higher than the other two scenarios that we have looked at because interest rate goes down, and therefore you will actually, the short-term investor will make a capital gain in this scenario. How about future value of reinvested coupon? Again, N is 4, everything is same. The yield will be, market rate will be 9.4. When you compute the future value, notice the future value is lowest amongst all the three scenarios, but the change is not that significant as much as the change in the price. So the price gain offsets the lower reinvestment return by a significant amount. The ending value, if you add these two numbers, is simply 130.59. And this is 11.17%. Compare this return of horizon yield of 11.17 versus original yield on the first day of 10.4. Why is it more? And the answer is because interest rates went down, resulting in a price gain, as a result of which the short-term investor ended up selling at a higher price and making a higher return than the original expected yield. So through these three examples, what have we illustrated? We have illustrated that the short-term investor returns are predominantly affected by price gains or losses. The reinvestment return, reinvestment gain or loss, is a very small portion of the total return. So while you're expected to know all the calculation that we have done here, in addition to this, in these two scenarios, you're also expected to know how to calculate the capital gain or loss. So let me focus on this scenario and show you, as we already know, there is a capital loss. So I'm going to show you how to calculate the amount of capital loss. That is something you should know as well. All right, so let's now see how to calculate the capital loss in scenario 2. Before that, let's look at what is a general formula for calculating capital gain or loss. We know capital gain or loss is generally calculated as selling price minus purchase price, right? So whatever I am selling at and whatever I purchased at. But if I link this back to financial reporting, we never calculated the capital gain or loss, or the gain or loss on the sale of long-term asset in this way, because this would be wrong. With this approach, you would always get loss on the sale of long-term asset, because if I'm selling an asset after 4 years and I'm comparing it against the purchase price of time 0, I will always end up with a loss for a simple reason. And the reason is, this is the price of a used asset. This was the price of a new asset when it was bought. You will always end up with a loss because the selling price generally is always lower than the purchase price. So here's what we did in financial reporting. We used to say selling price after 4 years minus the balance sheet value, which was the book value, or what we also called as depreciated value after 4 years, would actually give us the capital gain or loss after 4 years. So whenever you want to calculate the capital gain or loss on the sale of long-term asset, you look at the book value on the date of sale and compare it against the market price to get your capital gain or loss. So this was an appropriate way of actually calculating the capital gain or loss. The same goes with the bond. In the case of a bond, you cannot compare the selling price after 4 years with the purchase price of time 0. You have to compare the price of the bond with something called trajectory price at time 4 to get your gain or loss of time 4, which is the capital gain or loss. Now the question that arises is, what is trajectory price? Now here's what we have learned from our earlier understanding in fixed income. And in our case, we are looking at the example of a 10-year bond. Let's say x-axis is maturity of the bond, and on y-axis is the price of the bond. The bond that we are buying, which is a 10-year bond, is priced today for 85.50, and let's say this is the 10-year. We know that the price of the bond on the last day, let's say this is $100, okay? This is $100 price. We know that the price of the bond on the last day should be $100, meaning by the end of the maturity, it should equal $100. Why is that so? Because on the last day, if let's suppose today is the last day, what are the cash flows you're getting if you buy it today? All you're getting is just simply par value. Hence, bonds should be priced on the last day at par value. Based on this concept, Over a period of time, as the maturity shrinks, as the time shrinks, and assuming everything else stays constant except that time is reducing, so we are moving towards the maturity, what should happen to the price of a discount bond? This is our discount bond. Of course, it should go up to par value, because on the last day, it should equal par value. The same goes with if it was a premium bond. If it was a bond priced at a premium to par, it should come down to the par value. And this is called, this path that the discount bond takes or the premium bond takes is called constant yield price trajectory. In other words, there is a certain trajectory that the price of the bond follows, provided that nothing else changes except only time to maturity. So the time to maturity is actually shrinking. So this is the path that the bond would follow. Now, when we calculate the gain or loss, we actually compare the selling price, which is market price, against the trajectory price. So if after 4 years, this is where we are actually going to see what is the price according to this path, according to this trajectory. This price is called trajectory price. Now you may say then, okay, if this price is trajectory price, how do we actually find it? Well, for trajectory price calculation, we assume that we use the same discount rate as the original yield on the first day, which was actually yield to maturity. So selling price is nothing but, it's also price, and price at time 4 is present value of future cash flows at time 4. Trajectory price is also price at time 4, and this is present value of future cash flows at time 4. The difference is this is discounted at market rate, while this one should be discounted at original yield to calculate our trajectory price. So if in case the selling price is lower than trajectory price, we will have a capital loss. Vice versa, if it's above, there will be a capital gain. If I take you back to what were the cash flows, if you remember 4, 5, 6, 7, 8, 9, and 10. So the cash flows in both the cases would be 8, 8, 8, 8, and 100, right? So how do we find the selling price? We know N in this case is 6, payment is $8, future value, which is par value, is 100, the yield, which will be the market rate. In the second scenario, market rate was 11.4%. And we already calculated the present value before, but I'm still calculating it again for you. It will be 85.78. That's our selling price. How about the purchase price? How much is our purchase price? For purchase price, as we know, was 85.5. How do we calculate the trajectory price? The same set of cash flows, but discounted at original yield. N is 6. Payment is $8. Future value is $100. The yield will be the original yield. And we know original yield was 10.4%. And when we compute the present value, we get 89.66. So we got our trajectory price. The trajectory price is 89.66, while a selling price is 85.78. If we use the formula, which is 85.78 minus 89.66, the gain or loss that we get actually is minus 3.8, which means there is a capital loss. So we have found the capital loss in scenario 2. The same concept can be used to get the capital gain in scenario 3. And obviously, there is no capital gain or loss in scenario 1 because the market rate did not change or did not differ from the original yield. So I hope this was helpful. And just to conclude, here's what we have said. Going back to what we discussed, it's the price risk that is a more dominant component of the short-term investor, meaning the short-term investor returns are affected by price gain or price loss, while the long-term investor returns are actually affected by reinvestment gain or reinvestment loss.